someone who's interested in the intervening values or in the cash flows, it's terribly risky. So there isn't one concept of risk. A person who's retired or a few years from retirement with $1 million of savings is in a very different position than a 30-year-old tech millionaire who's just sold his company for $50 million. And so what one thinks is risky will not be there for the other. So you don't even have one view of risk. The third point, the one we're conscious of in our office here all the time, even the cleverest people make mistakes. You know, if you think emerging markets are good, invest something in emerging markets. Don't take all your money and put it there. And if you think they're bad, don't take all your money out because you could be wrong. So what we do is we move these portfolios, but we don't move them from one extreme to the other. We're rebalancing, changing the emphasis. We want to try and avoid the downs and try and capture the ups, but we don't believe our story completely. We could be wrong. And we have to be adaptable and to learn. That's what it means.
Let me go back and comment on something that George has said, and I'd also like to give a sample portfolio so people can kind of understand how we put this together. But I think George had mentioned that financial plan, and a lot of times when you talk to advisors, especially some of the mom-and-pop operations that tend to operate as registered investment advisory companies, you will typically get some input into a software system, and that input will then shoot out a 40-page document. I think more with disclosures than it actually is data, but nevertheless, it's a 40-page document. One of the things I think is very important when you sit down with our advisor, and one of the things that has to be done, and we've learned this over the years, and one of the things that that I've had the great joy in doing, since we're not pushing a product, since we don't just have mutual funds that we hand over to someone to have invest, we actually get to know our clients. And one of the things that, through observation, that we have noticed that if in the beginning of a process of investing, if you start to think in terms of buckets, and when I mean buckets, what do you have in the near term as a need from liquidity, yield, and expenditures? And if you put those monies in one bucket, and let's say that's a 3-year commitment, that's a rolling 3-year, a certain amount of liquidity that produces a certain amount of yield, and then you look at your other money as long-term, and you put that into a core diversified strategy, what we have found that this is a emotionally fulfilling to clients, and clients do not tend to overreact to the ups and downs of the market. And I think this is very important, much more important than someone producing a 40-page document. It's a discussion. It's a real discussion. As I talk to people always walking in the office, well, I'm not really sure what I want. But as you get to know them and you go through conversations with them, they really do know what they want. Sometimes they put it into conversation of, we want to pay for college, we want to buy a home, and that is what the advisor is there for, to understand those needs and quantify those needs and help build an investment strategy. So a lot of times what you'll see once we get to the end of the day, we will talk to our clients about a diversified portfolio. We point out the bucket of cash that is there for them to meet those types of needs over the next 3 years, and then we discuss the more diversified strategy that is in place to take advantage of long-term growth. I think this is a fundamental key to investing. I invite any one of the participants on the call to contact our office. The office line is 702-855-4812. Let them know that you are a participant in today's webinar and that you would like to sit down. Call us, let us know that you want us to be part of your team and help put this type of plan together. Call us and ask us if we could take a second look at an allocation strategy that you already have. We are happy to do that. We enjoy doing that. We think it adds a lot of value. And of course, we do that with whether you're a bank client, whether you're using us for investment management. But I think it is a very good value add to look at how you're currently invested based on the information that George shared with us, and then based on a personal conversation of your near-term needs and then a long-term portfolio. With that said, George, we're running out of time, but obviously in any questions we have several questions in queue here. We'll respond back. One of the questions that I think you constantly get, I constantly get every time I speak is obviously the conversation of gold. In the case that we always see several questions, should I store gold? How do you respond to that? I know whether it's a valuation question or what's your opinion on gold and storing physical gold or physical assets?
Okay, I think that there is a substantial amount of substance to investing in gold and a substantial amount of hysteria. As you saw earlier, the price of gold has risen for the last decade. It hasn't risen for the last 30 years, but it's risen for the last decade. Gold is a psychologically priced asset. Gold is worth what you think it's worth. If you take almost any other precious metal, silver, platinum, and so on, they have industrial uses. For example, platinum is used in, its main use is in catalytic converters in cars. And what that means is I know the floor value. Even if no one wanted to invest in platinum, I can look at the number of automobiles being produced and I can think of the demand and I can say, well, at a minimum, this is going to be the price. So I have an economic analysis, and I can do that for silver and copper and you name it. Gold has no industrial uses. I mean, I have some in my teeth. Maybe Russell does too. I have a wedding ring. That's not very large. And you know, various people have jewelry. But apart from gold watches and jewelry and dental work, there aren't any industrial uses for gold. And almost all the gold in the world is not in use in wedding rings. It's held for speculative purposes. So when people are bullish on gold, its price goes up. And when people are negative on gold, its price goes down. Now, certainly people have been bullish on gold for some time, and our guess is they'll be bullish for a while longer, though we believe this will all collapse again. So that's an argument for investing in gold. It's not an argument for investing in physical gold, digging a hole in your backyard and sticking it in. It's an argument for a financial investment in gold. Why would you ever hold physical gold? Well, because you didn't trust the financial system, so your financial claim on gold you'd think wouldn't be honored. The only reason why anyone would hold physical gold is if they anticipated some massive amount of social collapse, that the whole banking system would disappear and all this sort of stuff. There is absolutely no evidence that any of this is going to happen. Gold has a negative carry. What does that mean? It means if you have a gold bar and you want to store it somewhere, if you stored it in a vault at Nevada State Bank, they would charge you. Now, Russell's a nice guy, but he'll still charge you. And not only that, but you forego interest. So if you put $1 million into gold bars, that's $1 million that's not earning anything. In today's market, you know, when money market funds are paying 2 basis points, that costs 0. I told you soon interest rates are going to be at 6 and 8%. So you've got a choice of holding a gold bar or earning 6 or 8%. Why would you ever hold gold? Only if you thought there was going to be a major social disaster.
So an emotional comfort versus
It's a very expensive emotional comfort. I don't know whether any of you have ever picked up a gold bar. You're not going to flee the country with a suitcase full of gold unless you have a very large truck with you. Gold is heavy.
Thank you very much, George. For those that do have questions in the queue, we're out of time. I don't want to hold our busy participants up. Nate, I think we are done here, and we will answer questions in the queue after we end the call.